This is the K-State Radio Network. Thanks, as always, for being along with us for Agriculture Today. Well, we saw yesterday in the grain futures an assertive move to the upside. We'll talk about what was behind that and other market matters as we're joined once again by K-State Research and Extension grain market economist Dan O'Brien from his office in Colby, northwest Kansas. This still, Dan, appears to be all about weather issues, not only here in the U.S., but in South America. That is carrying the day yet.
Yes, we have positive pricing opportunities that if you'd asked us during December and January if we'd expect to see these, we'd have only hoped for them.
Right.
Well, now they're here, and we saw in yesterday's closes that March contract 378 3/4, May 386 1/4, and maybe even more important for a lot of people's planning for next crop pricing is that December corn's above $4. Well, it closed yesterday at least it was yesterday. It's closed 404 3/4. Soybeans lead contract 1057.5. Now November a little weaker than that. Not the same upward carry, but again you've got that Brazilian soybean crop coming on. New crop November 2018 at 1038, and of course corn was up. Well, the July through March up 4 to 4 1/4 cents, and all contracts up at least 2.5 3 cents. Yesterday, from March through August, we were up. Well, March through July, all up 12 cents. August up 10. The wheat market, in response to dry conditions in hard red winter wheat area, and read that a lot of that Kansas, closed up 22 3/4 cents yesterday in the March contract, up to 531. May 543.5, up 21 1/4. July 560, December 593. So you had those positive carries going on, and we'll talk a little bit more, I think, later on as to why the carrying charges are doing what they're doing in the wheat contract. But I would just say on wheat, I remember back in I think it was 2010 when, in response to dry conditions in the Soviet Union and reports that there were wildfires outside of Moscow, that the wheat market exploded. Well, here, part of the issues that has come back in last year or so here is literally a dry weather warning for a good part of southwest Kansas, some of the parts that had weather problems, fire problems last year. So that forecast I think that's part of the issue that got the attention of the wheat market. So here we're seeing a run-up from lows in the corn market from, again, early January, we were at 345 or so, 350, 355, somewhere in there for a low. Now we're up to 386. Still not a barn burner, full-scale drought, but it's positive. And for the wheat markets, we had been down to about 425 or so, again, during November, December, and now we've jumped up to 543.5. It sure merits thought. Here we've seen these things come now, and really the question for people to ask themselves, I believe, is there something there to act on, And again, for wheat, we're unsure of our own crop yet, but with crop insurance, et cetera, it brings up the idea of wondering about actions to take. And for bean futures closed yesterday at 1068, had been down to about 952, 955 in early January. So we've had some run-ups on these things.
Dan, it's interesting in that there was bearish news in the market, which it apparently absorbed without breaking stride, and that is that the Trump administration announced the intention of imposing stiff tariffs on aluminum and steel imports, and as that was being discussed prior, that was something of a worry in the agricultural sector.
I think the worry has been that in similar fashion to what occurred with grain sorghum, as the Chinese had put a tariff on grain sorghum imports in response to, I think, a solar panel dumping issues, or at least the allegation of that if there were other sanctions on other manufactured goods coming into the U.S., particularly involving China, that there would be either tariffs or a vacating of business or something that could happen and could affect these other markets, and in particular soybeans. Of course, the big issue with soybeans is that there aren't that many places in the world to buy soybeans. And with the drought that they're seeing in Argentina in particular, parts of southern Brazil, that we're seeing not growing prospects to any large degree in terms of supplies for soybeans. Now that the Brazilian crop looks tremendous from what we're told. Not out of the woods yet, of course, in terms of what it finally will be. So if crop conditions throughout South America were just tremendous without any worry of short supplies, then we would be all that much more vulnerable to retaliation. Mm-hmm. I think it's hard in our ag sector to see all the different ag plus non-ag issues that are on the table in these negotiations. And I think we need to be careful of being either pro or critical of some of these actions as trade negotiations go on between these countries. For us, we're just treating the symptoms.
Right.
The symptoms are that here at a time when we've had markets run up, we have this issue out there that could put us at risk. It does make I think all that much more. It would cause us in the grain markets to look and see what we have right here and ask, are these actionable prices, especially on the new crop side. And yes, we have old crop sales too, but the possibility of trade issues, particularly with China being so important in world ag markets, is, quote, out there. And if that happens, it's maybe the markets would just shrug it off. But there's significant risk that they wouldn't, and it would have some negative impact, even in the midst of drought in some of these key production areas. Even in the midst of that, for soybeans, you would wonder where the markets would go.
Yeah. Well, Dan, you brought this up just a moment ago. Let's expand on it. We are now through the first cycle, if you will, of the variable storage rate attached to the Kansas City hard red winter wheat contract. And this has been trotted out as a potential remedy for lack of convergence in wheat prices, which we've discussed at length right here. What's the word on that, if you would?
Well, in a nutshell, basically, we've gone through the first decision-making period on whether the VSR mechanism would work to raise storage rates for paper contracts within Kansas City hard red winter wheat. And we could talk you through all the specifics and technical aspects of it, but the result is that basically coming out of that first decision period, the CME had the feedback from watching contract spreads, and they raised the cost of storing these warehouse receipts for these hard red winter wheat futures. It raised it from about 6 cents up to 8 cents. On yesterday's closes, when you walk right back into Kansas City hard red winter wheat futures and look at the spread from March to May, it's 6 1/4 cents on yesterday's closes, and then from May to July, it's 8 1/4. Then from July to September, just under 8 cents, and it kind of declines off from there. So it looks to me, like that 8 cents is sure represented in the May to July spread, and to some degree from July into September. But it's telling that carry is not going in lockstep out into December and March. The market may be anticipating that short supplies here in the U.S. could affect supply-demand balances enough that the VSR mechanism could undo these price rises and take things lower. I mean, that's how I interpret it at first glance. But anyway, so now you have carrying charges. So whatever they do in the VSR gets reflected, has tended to very consistently get reflected in the carrying charges in the futures contracts. So now, when we look out to July futures at 560, and when March is closed yesterday at 531, that 29 cents has a lot to do with the VSR or anticipation of the VSR mechanism affecting these carrying charges. And for new crop pricing, that's 31 cents. It's not just a level contract. That's 31 cents carry from upfront March out into July. And really, I think the question, Eric, our folks are going to be wrestling with as long as these VSR mechanisms are in play is, again, what I look at in any one day in carrying charges that are kind of caused by the VSR, at least in part, are they going to stick around all the way through to the time frame when what's now a deferred contract becomes the lead, Mm-hmm. And if they tend to erode through time, then gosh, we've got hedging, storage hedge, forward contract hedge opportunities to be looking for. And the next big issue, and maybe we in Kansas are going to be ahead of the curve for once on this one, there's a lot of discussion on part of CME of taking the VSR mechanism over now into corn and soybean futures. If that happens, for one thing, after having watched how this thing behaves on wheat, I think we'll be better equipped to see how it might behave, how it might affect the markets for corn and soybeans.
Well, we really haven't had enough time right here to do justice to all the points that Dan has made in his weekly notes on the grain market, so we'd again refer you producers to those, which can be found at agmanager.info, out of K-State, agmanager.info. Dan, we'll do this again next Friday. Until then, many thanks.
Thanks, Eric. Take care.
His weekly comments on the grain market trends. Dan O'Brien is a grain market economist, K-State Research and Extension. Agriculture Today resumes after this over the K-State Radio Network.
While many people know hunger is an issue in developing countries, it is also a problem in our own backyards. In 2010, 1 in 7 Kansans struggled to put adequate food on the table. 2 K-State Research and Extension programs are tackling this problem. The Family Nutrition Program and Expanded Food and Nutrition Education Program reach thousands of Kansans in more than 70 counties. They learn how to eat healthy with a low budget. For more information about these programs, visit ksre.ksu.edu.
Agriculture Today is back now. Well, K-State Research and Extension agricultural economists have teamed up with a counterpart from the University of Nebraska this week and into next week to put on that series of Farm Bill meetings throughout Kansas and Nebraska, and 2 of those have taken place already in Kansas, the others to come up in Nebraska next week. We're joined now by one of the principals conducting these. He is Brad Lubben, agricultural policy specialist at the University of Nebraska, and he does keep close tabs on what's going on the Farm Bill front. And Brad, just quickly here, as you visited with producers in Dodge City earlier this week as well as here in Manhattan, what seem to be those matters of concern or interest that producers are expressing to you about the makeup of this next Farm Bill?
Well, we've heard from producers at those meetings, and the topics have covered the major questions we've been dealing with. Potential reforms in the commodity program, asking for at least maintaining the support that we have in the present programs given the financial challenges and low prices that we see today, but looking for potential fixes, particularly to the ARC program. We've also seen calls for trying to maintain the support in the crop insurance program and calls for continued support and even increased funding in conservation. Those have been widespread topics of discussion and certainly a push for more support in this Farm Bill. Recognizing the challenge of finding that additional support is always going to be a difficult task.
Well, it just so happens that all of that is well woven into your presentation at these meetings, and let's take up some of those individually. The commodity program, and this time around for the 2018 Farm Bill, producers will have the opportunity to choose once more between ARC and PLC, something they haven't done since the 14 Farm Bill was initiated. And what are you sharing along that line?
Yeah. Well, we should clarify that we expect producers will have a new decision in 2019. The decision they made between ARC and PLC in 2014 was a commitment through the 18 crop year. Whether we get the new Farm Bill on time, as we hope for, or whether we end up with an extension of current policy, we do rather expect that producers will have a new decision in 2019. One could say that might be the most important fundamental element in the commodity program, is to make sure we have a decision. Because changing economics, changing price outlook have changed the relative guarantees in the ARC program, and they've dropped over time. While ARC started with a very strong guarantee, it's gone down over time as a moving average. The PLC program has started out of the money, and unfortunately we've dropped to points where PLC is deep in the money. And the kinds of decisions producers make in 19 might look very different than what they made back in 2014. That's a big component of the commodity title discussion. There are other issues, other concerns, particularly with ARC, trying to resolve continuing concerns about yield data and how the yield portion of the equation is calculated, as well as perhaps trying to rebalance some of the support between different commodities. But frankly, all of those might pale compared to the the new decision producers would have in 2019.
But structurally, we're not talking about much different with those two options. It will be more or less business as usual, it sounds.
That seems to be the major road forward. The status quo of ARC and PLC, while everybody has particular areas they'd like to look at, the general principles seem to continue with strong support, and some form of that going forward looks like the likely path.
One of the true lightning rods amidst all the pre-Farm Bill discussion has been what will happen with crop insurance, if anything. Now, colleague Art Barnaby from K-State is largely addressing the nuts and bolts of that at these meetings, but you're taking that on, too, as one of the pillars of discussion. Your thoughts on whether we're going to see limitations on premium subsidies and otherwise.
Right. As you described, crop insurance is certainly taking its hits. It's the biggest component right now. Crop insurance title and the federal support for crop insurance amounts to more than the support in the commodity title. So it's the number one target. And the interest groups from outside of agriculture have been identifying potential crop insurance cuts. Now, agricultural groups have strongly said, please do no harm, maintain crop insurance, keep that support in place. It's the number one priority. And I would not expect the ag committees to carry forward anything less. The chances for potential cuts or changes to crop insurance seem more likely on the floor in both the House or the Senate, where an amendment in the Farm Bill process might propose cuts. We've heard cuts proposed of cutting the eligibility, either in terms of an adjusted gross income cap or some premium subsidy limit that would limit the total dollars of premium support that a producer could benefit from. We've also heard proposals to cut features of the crop insurance program, namely the harvest price. And yet the analysis of crop insurance would reinforce the importance of harvest price for anyone who actually marries up crop insurance with a good marketing strategy. So the proposed cuts don't necessarily match up what the fundamental purpose of the program is, but they identify spending targets. The one that might end up with carrying the most weight is whether there's a potential reduction in the overall subsidy rate. Currently, if you take the entire crop insurance portfolio, the federal government's share is about 62% of the premium dollars. Will that back up? How far? That might be the ultimate choice to be made somewhere within the Farm Bill debate.
Too dangerous to speculate on how that might roll?
Well, it's a bit uncertain to say how much budget pressure there is to find a cut or to find dollars to pay for something else, but certainly it sort of is out there as one of the leading targets if there is a cut. And on the floor, the support for that kind of a move on crop insurance could be different, certainly very different than what it is within the Ag Committee. We would, as I said, we would not expect this kind of action to come out of the Ag Committee that is strongly supportive of the role of a safety net. The floor is a little bit different matter.
And you touched upon this a moment ago, in the limelight, but to a lesser extent, the conservation title and potential changes. That largely has to do with the disposition of the Conservation Reserve Program moving forward, you say.
Right. We can look at the major spending categories in conservation where those federal dollars are invested. CRP is about a little bit less than half of the total dollars, but it is a much smaller CRP than it was a decade ago. We've shrunk from 37 million acres to 23 million acres, but we've also shrunk the cap. So we're really constrained from growing the CRP from its present size. That puts pressure on some of those general enrollments across this region particularly, that as those expire, the chances of re-enrolling, if there's interest, are pretty limited. Of course, now that we're also working through lower commodity prices, there's more interest in potentially re-enrolling, and yet there's less availability under this lower cap. Some proposals have suggested raising the cap, which of course costs money. Some proposals have suggested lowering the rental rate to 80% of the max of the county average instead of the current 100%. The CRP rental rates, the maximum rates that can be paid, are a function of county average rents. Those lag the rental market by at least a year, which lags the profitability of cropping. So by no shock or surprise, those CRP rental rates look pretty attractive compared to current crop economics. They eventually catch up, but cutting them by 20% may still compare pretty directly with cropping decisions, such that we may not fundamentally change total interest in the CRP. So if you can cut rates to save money and that money pays for an expanded CRP, that might end up being one of the prime options here going forward.
Well, that's a sampling of all of the issues that will be wrangled as the Farm Bill debate picks up, and the chances of this bill being done before the current legislation expires late September of this year. Are they relatively good? How are you reading that right now?
Well, I've been describing myself as cynically optimistic, which is to say, I think Congress wants to get it done so that they can get back on the campaign trail and demonstrate that they got something done. They did get a tax reform bill done at the end of 2017. They did get a 2-year budget deal done here in early February. So they are getting some things across the finish line. This would be another thing that would demonstrate that. On the other hand, there's a substantial amount of uncertainty about some of the issues to address yet, so it's not a perfect path to the end. And there's frankly even uncertainty about control of Congress going into this election and coming out the other side, to the extent that both parties have to play the political game as much as they have to play the legislative process here. Now that we've resolved some budget issues, particularly with cotton and dairy policy, we may be able to start this process very quickly and move quite rapidly. That's when we really learn what's currently on the table in terms of this option is really under serious consideration versus that option. So it's not a clear path, but optimistic.
Good to have you back in the state of Kansas, Brad, and good luck on the rest of these meetings in this series. And if we might, we'll be in contact as more fleshes out on the Farm Bill debate here in the coming weeks and months. We always appreciate your time.
It's good to be with you down here at K-State.
That's Brad Lubben, agricultural policy specialist at the University of Nebraska, who has teamed up with K-State's Art Barnaby and Michael Taylor and others here at the university to put on these Farm Bill forums in Kansas and Nebraska this week and next. He's been our guest on this part of Agriculture Today, and we'll return in a few moments with more here on the K-State Radio Network.
Have you ever thought about where your food comes from? If you're thinking the grocery store, think again. Facts show that the American farmer feeds more than 129 people.
They are continually increasing and improving their operations. A wide variety of crops and livestock are grown in Kansas as well as the United States, providing food to your dinner plate.
Next time you see a farmer or rancher, thank them. For more information, contact K-State Research and Extension.
This Agriculture Today closes out with the latest from the Weather Data Library at K-State on Kansas agricultural weather. Over from that laboratory is research and extension climatologist Mary Knapp for her weekly report. And this time, Mary, a summary of the weather in Kansas for the month of February. And you don't have to be terribly astute to at least guess that we were drier than normal around the state.
Right. The exception to that is the southeastern division is showing just slightly above normal with an average of 1.99 inches, which is 109% of normal. The cautionary note with that is that it was highly concentrated in the extreme southeastern portion of that division. So in the Columbus area, Cherokee County, that was where they had the bulk of that moisture. And it also is worth noting that most of that came in the last week. Mm-hmm. So again, it was not evenly distributed over the month, and it wasn't evenly distributed over the division either. On the opposite side of the state, in southwestern Kansas, they had a dismal 2% of their normal February moisture. And we note that February is not a particularly wet month for them, but getting 2% is certainly not helping matters at all. That averaged 0.02 of an inch for the division. The rest of the divisions are mixed in between that. Nobody else has seen even half of their normal February precipitation. So again, dry is the major characteristic for the month.
And then it was colder than normal for the month, which actually turns out to be something of a blessing.
Right. There are two benefits for the cooler than normal temperatures, and we should note that ranges from 5 degrees cooler than normal on average in the northwest to just under 2 degrees cooler than normal on the southeast. One of those benefits, of course, is the fact that the evaporative demand is going to be much lower when you have those colder temperatures. On the second hand, the other benefit is that vegetation has not removed itself from dormancy nearly as quickly or as rapidly as it has done in previous springtimes. So that means, again, less demand on what available water there is, and also a reduced risk for the freeze damage that you can get when you have that early emergence and removal from dormancy, and then you get slammed with a normal freeze date. That risk is a little bit less.
Well, that's how the table is set heading into spring. Not officially there yet, but in about 2.5, 3 weeks we'll get there. It would seem that it's going to be difficult to get caught back up on moisture. In fact, the potential for being further behind is there.
Right. Typically, a March could make a big recovery. We're moving into our wetter season, and so the normal rainfall that we get almost doubles from what you would expect in February. So if we had normal precip, we could recover pretty quickly. Unfortunately, the Climate Prediction Center's forecast for the month of March, which has been updated, doesn't look encouraging. The western third of the state, actually more from central Kansas westward, is tilted towards drier than normal for the March. In the eastern part of the state, it's equally likely to be above or below normal, with maybe a tiny sliver along the Missouri-Oklahoma border in that southeastern corner for normal to maybe a slight wet pattern. And again, that could be one storm system tilting the odds towards the wet pattern. But overall, it's looking like it's going to be a dry March. And to let the other shoe drop, the bad news on temperatures, they're expecting it to be warmer than normal statewide. That's a switch from the mid-February outlook for March, which had called for the cooler pattern to continue across the northern half of the state. We're going to get some more ridging in the west, and that will push those warmer temperatures further north.
More immediately, there is talk of a system moving in late weekend, Sunday into Monday, and perhaps providing some level of moisture. What's the reality of that?
Well, unfortunately, it looks like it may be a repeat of this last weekend system. We had a chance Sunday into Monday when a system went through. It was depressingly light for everybody except that southeastern corner of the state. The quantitative precip forecast, which looks at how much water might be squeezed out of the atmosphere in the next week, is generally calling for 1/10 to 1/4 of an inch in the counties along the Missouri border. You move westward to maybe as far as Salina and follow that line north and south, and you're going from 1/100th to 1/10 of an inch. And anywhere west of that, they're looking at basically 0 to 1/100th of an inch. Not by any way, shape, or form the kind of moisture levels that we need to start making a reversal in this drought pattern.
Well, let's finish on a more upbeat note and let folks know about something that's available to them at the Weather Data Library's website out of K-State, a new upgraded page on soil temperatures, and very timely as we head into the planting season.
Yes, we've released the new webpage. You can still get back to the old one if you have fallen in love with that old method of retrieving data. But the new page has some very nice features in it. One is that it's much easier for you to hover over and change which station you're looking at so that you can look at the ones surrounding your particular area. The other is that there is a mapping feature that will show the statewide patterns, and you can switch those maps from 2-inch to 4-inch weekly averages. You can also do the max or min averages for the week. Then one feature that I'm particularly excited about is the graphing feature. So not only do you see what those average temperatures are, you can graph for the individual station how it's changed over the week. So you can look at the variation and the variability that those soil temperatures have had.
So you can keep your own running account of the soil temperature trends in your area, and that is found at mesonet.ksu.edu, mesonet.ksu.edu. Check that out. And Mary, we'll have you back next Friday. Thank you.
Thanks, Eric.
Research and Extension climatologist at K-State, Mary Knapp, noting that starting next week we'll have our series of features profiling the Kansas Master Farm families for this year. That'll start on Monday, so please be back with us for that and more, if you would. Meantime, enjoy your weekend. Eric Atkinson here for Agriculture Today over the K-State Radio Network.